Welcome back to Talk Tickers. It is Wednesday, February 18th, 2026. And I have to tell you, if you've been watching the markets, or honestly, if you've just been breathing the air in Silicon Valley for the last 12 hours, you know exactly what kind of day it is. It is electric.
It is a green day, a very, very green day. Honestly, a relief day, a huge relief day.
We are talking about the Arista Networks Q4 2025 earnings call. Ticker symbol ANET.
Yeah.
And let me just set the stage here, because the vibe going into this print was, well, it was tense. People were sweating. I was looking at the options chain yesterday afternoon, and the implied volatility was just screaming.
Tense is putting it mildly. There was this pervasive fear in the market, really since the start of the year, that we were hitting a wall. The digestion phase narrative was everywhere. It was the only thing analysts wanted to talk about.
Right.
The idea was that the hyperscalers, Microsoft, Meta, Google, they had bought so much kit in 2024 and 2025 that they simply had to stop. They had to take a breath, plug it all in, and actually turn the power on before buying more.
Exactly. The party is over. Turn on the lights, go home. The hangover's here.
Mm-hmm.
And on top of that, you had the memory market going absolutely haywire. We've been tracking HBM and DDR5 prices, and they have been just skyrocketing.
Oh, completely vertical.
And the assumption was that this input cost was going to crush margins for hardware makers.
Yeah.
If you make a switch and the chips inside it suddenly cost double, you're in trouble.
Exactly. The setup was perfect for a miss. Or if not a miss, a beat and lower, where they beat the quarter but then guide down for the future because of macro headwinds and all that noise.
But that's not what happened.
And then Arista dropped the press release after the bell yesterday.
And boom, the stock is an absolute ripper. We are talking a 7.68% move after hours, pushing right past $145.
Yeah.
The digestion phase, canceled.
It wasn't just a beat, it was a statement. I mean, Arista didn't just survive the quarter. They flexed. They flexed hard. They beat on the top and bottom line, sure. But the real story, the thing that has everyone scrambling to update their Excel models this morning, is the guidance.
The guidance?
They raised the full year 2026 outlook significantly.
And that is why we are doing this deep dive today. Because this isn't just about a networking company selling switches. Arista has effectively become the proxy for the entire AI infrastructure build-out.
It's the canary in the coal mine.
Right. If Arista is saying we need to raise guidance, it means the AI boom has legs for another year, minimum. The demand is not slowing down.
That's the narrative. If the pipes are getting bigger, it means the data flowing through them is growing. So let's unpack this quarter, because the numbers are frankly staggering for a company of this size.
Let's do it. Let's start with the headline numbers for Q4 2025. What did they actually put on the board?
So for the fourth quarter, revenue came in at $2.488 billion. That is up 28.9% year over year.
28.9%.
Yeah. And to put that in context, the street was looking for something closer to $2.39 billion. So they beat the revenue number by nearly $100 million.
A $100 million beat on a quarterly print is not a rounding error. That is real volume. That's real demand.
No, it's substantial. That tells you that shipments were absolutely flying out the door in December. Then on the earnings front, non-GAAP EPS hit $0.82, beating the street expectation of 76 cents. GAAP EPS was 75 cents.
So solid beats across the board.
Solid beats. But again, in this market, past performance is interesting, but future guidance is everything. And that is where the real fireworks happened.
Right, because usually you get a beat and then the CFO comes on and says, but we remain cautious due to macroeconomic headwinds, and the stock just tanks. That did not happen here.
Not even close. Management came out and lifted the full year 2026 growth target to approximately 25%.
25% for the full year.
For the full year. Now let's do the math on that. They finished 2025 with about $9 billion in revenue. A 25% growth rate on top of that puts their fiscal year 2026 revenue at roughly $11.25 billion.
That is massive scale. I mean, growing at 25% when you are already at a $9 billion run rate is incredible physics.
Yeah.
It's just hard to move a ship that big that fast.
It is rare air. Usually growth slows down as the denominator gets bigger. Arista is somehow accelerating. And they got specific about where that growth is coming from.
The AI piece.
The AI piece. They raised the specific AI networking revenue target for 2026 from $2.75 billion to $3.25 billion.
Wow. So that's a $500 million bump.
A $500 million bump in pure AI expectation just since the last time they spoke to us 3 months ago.
That is the signal right there. That $500 million is basically them saying, The clusters are getting bigger, and they are getting bigger faster than even we saw it 3 months ago.
Yeah.
That's not just inventory build, that's real deployment.
It's a direct read on hyperscaler CapEx. And we have to talk about margins because this is where the operational discipline really shines. Despite everything happening in the supply chain, and we will definitely get into the horrendous memory prices in a bit, gross margin came in at 63.4% on a non-GAAP basis.
Holding up incredibly well. And the guide, did they guide margins down?
They're holding the line. They guided Q1 2026 margins to 62-63% and maintained the 62-64% band for the full year. Given the headwinds, that is basically magic.
It's astounding. And they are still buying back stock on top of all this.
Yep. They bought back $1.6 billion in stock in fiscal year 25, and they still have about $817 million left in the authorization. So the capital return engine is just humming along in the background while they are growing at 25%.
Okay, so the headline is, we are growing faster than you thought, we're doing it profitably, and we're returning cash to shareholders. It's the whole package.
It's the trifecta.
But I want to get into the how, because the composition of who is buying this stuff is fascinating.
Yeah.
Let's talk about the titans.
Oh, yes, the cloud and AI titans. This is Arista's bread and butter. This segment now makes up 48% of their total business.
Almost half the company.
Almost half the company is serving these massive, massive hyperscalers.
I have heard Arista described as the arms dealer for the cloud wars, and that number really backs it up. But it's not just a generic group of titans, right? There is some serious concentration here, and I want to push on this because concentration usually scares the hell out of investors.
It does, and for good reason. When you look at the 10% customers, so companies that account for more than 10% of Arista's total revenue, we have two big ones. Customer A accounted for 16% of revenue in 2025.
Okay, 16%. Big, but manageable.
But then you have customer B. Customer B accounted for 26% of revenue.
Wait, 26%. One company is a quarter of their entire business.
Yes, a quarter of the business.
Oh.
So between the two of them, that is 42% of Arista's revenue wrapped up in just two names. Now, they don't name them, but the street consensus is that these are almost certainly Microsoft and Meta.
42%. That is. That's high risk, high reward.
Yeah.
If customer B sneezes, Arista catches pneumonia. I mean, if Meta decides, hey, we're good on GPUs for a while, Arista loses a quarter of their revenue overnight.
That is the bear case, certainly. And it's the big, scary number in the 10K. But right now, customer B is running a marathon, not sneezing. And honestly, at this scale, who else can buy this much equipment? These are really the only companies with the checkbooks big enough to move the needle like this.
That's a fair point.
But here's the crumb that management dropped that I think is the most exciting part of the call regarding customers. They said they anticipate one or two additional 10% customers emerging in 2026.
Ooh, one or two new giants.
Exactly. They are seeing the pipeline, and they believe another player, or maybe two, is about to step up their spend to that massive, massive level.
That is the race to be the third giant.
Yeah.
Who do we think that is? Is it Amazon finally switching over from their own custom silicon? Is it Google? Or is it like someone else entirely?
It could be a few things. It could be Oracle, who has been incredibly aggressive. You know, Oracle has been building out these massive clusters to rent out. It could be a massive dedicated AI lab like an OpenAI or an Anthropic who decides to build their own infrastructure directly rather than just using a cloud provider.
That makes sense.
But regardless of who it is, it signals that the market is deepening. It's not just a two-horse race anymore, and that de-risks the whole story a little bit.
Speaking of deepening the market, Arista actually changed how they report their customer segments this quarter, which I thought was really interesting. They introduced a new category called AI and specialty providers.
This was a very, very smart move. It used to be just cloud titans and enterprise, kind of a catch-all. But now they've carved out this AI and specialty bucket, which is already 20% of revenue.
20% already. And this is where things get really colorful. Because inside this bucket, you have what they call the neoclouds.
The neoclouds, I love this term. Management was very candid here. These are the data centers funded by, and I am quoting here, oil money or crypto money.
I loved that detail on the call. It's literally petrodollars and Bitcoin gains being funneled into buying racks of GPUs. It sounds like something out of a cyberpunk novel.
It really is. You have sovereign wealth funds in the Middle East. You have crypto mining operations pivoting to AI. They have immense capital, and they want to build sovereign AI clouds. But management was also cautious. They explicitly said, we check their credit.
We check their credit. That's the most polite corporate way of saying, we make sure the check clears before we ship you billions of dollars worth of switches.
Exactly. They are happy to take the orders, but they know that some of these neoclouds might be tourists. They might build one massive cluster and then run out of cash or business model. These aren't 30-year-old companies with AAA credit ratings, you know?
Right, versus the other part of that bucket, the specialty clouds. The companies like Oracle or, the CoreWeave types.
Exactly. Those are the settlers. They are building long-term infrastructure businesses. So by separating this category, Arista is showing us that the market is maturing. It's separating the speculative money from the structural money.
And the fact that this segment is already 20% of revenue shows that the demand for AI networking has moved way beyond just Microsoft and Meta. It's global, and it's diverse.
And it's getting more diverse by the quarter.
Now, I want to pivot to a specific saga we've been tracking on the show, the fourth customer. We've been tracking this for a few quarters now. Arista has talked about 4 major AI clusters. 3 of them were fully deployed, but the fourth one was the holdout.
The elusive fourth customer.
Yeah.
Yes. The story here has been that this customer was historically an InfiniBand shop.
Right.
For those listening who aren't network engineers, InfiniBand is the proprietary high-speed cabling standard, mostly pushed by NVIDIA. That was the default for AI training for all time. Ethernet, which is Arista's technology, is the open standard.
And the battle has been, can Ethernet be fast enough and reliable enough to kill InfiniBand? Because the argument was always that Ethernet is lossy.
Yeah.
It drops packets. And when you were training a trillion parameter model, dropping even a few packets is a disaster.
That was the argument. That was the FUD, the fear, uncertainty, and doubt. But Arista has spent years engineering that problem away. And this quarter gave us the answer. Management updated us that this fourth customer is officially migrating from InfiniBand to Ethernet.
So the holdout folded, they switched.
They're switching. They are currently under 100,000 GPUs, but they are expected to cross that line in 2026. They're building out their next-gen clusters on Ethernet.
And that is a massive validation of the Ethernet winning over InfiniBand thesis. It's playing out in real time. If you can get a legacy InfiniBand customer to rip and replace or at least build their new massive clusters on Ethernet, the war is effectively over.
It's a huge domino to fall.
Why is that switch such a big deal, technically speaking? I mean, is it just about cost? Is Ethernet that much cheaper?
Cost is part of it, for sure, but it's really about scale and openness. When you build a cluster with 100,000 GPUs, the complexity is exponential. InfiniBand is fantastic for small, tight supercomputers, but when you try to stretch it across a massive data center with miles of cable, it gets brittle.
It doesn't scale well.
Not as well as Ethernet. Ethernet is the language of the internet. It was designed to scale. It breaks less often. And Arista has proven that with their new switches and their EOS software, the speed difference is negligible for these AI workloads. Plus, you avoid vendor lock-in.
Right. These big customers hate vendor lock-in more than anything.
They despise it. So with Ethernet, they can buy switches from Arista, from someone else. They can mix and match. With InfiniBand, you're buying the whole stack from one company.
So the Ferrari is stuck in traffic, and the Honda Civic Ethernet just got a jet engine strapped to it.
A jet engine and a much better price tag. And a supply chain that isn't controlled by a single vendor. That matters a lot to these companies.
That is a huge strategic win. But I want to pivot to something that sounds boring but is actually incredibly dramatic. Supply chain and margins. This is where I want to challenge the narrative a little bit.
Oh, this is the operational drama of the quarter, for sure.
We mentioned earlier that memory prices are horrendous. That is a direct quote from the CEO, Jayshree Ullal. Prices are horrendous.
She didn't mince words at all. She said they are smiling and taking it.
So we have memory prices, DDR5, HBM. They're skyrocketing because of the AI demand. In theory, this should absolutely crush Arista's gross margin. If your inputs get twice as expensive, your profits should go down. But they didn't. They held the line. Why? How?
2 words. Purchase commitments.
Okay, break that down first. What does that mean?
It means Arista saw this coming. They looked at the landscape in 2025 and said, we need to own the supply. We cannot be at the mercy of the spot market. So they ramped up their purchase commitments to $6.8 billion.
$6.8 billion.
Yeah, that is up from $4.8 billion.
They spent nearly $7 million locking in chips ahead of time.
They committed to it, yes. They effectively went to the memory makers and said, we will take all of this supply at this price for the next year. They bought it before the price hike fully hit the rest of the market. It's a massive, massive bet.
You're using their balance sheet to do it.
Exactly. Remember, they have over $10 billion in cash and equivalents. They are using that cash pile to bully the supply chain.
Okay, I have to push back on this for a second because you're painting this $6.8 billion purchase commitment as this masterstroke, this operational alpha. But let's look at the other side of that coin.
Okay.
Arista is a networking company, not a bank or a hedge fund. They're committing nearly $7 billion. That is a massive chunk of their liquidity to buy memory chips.
It's a huge bet, no question.
And we know how fast this industry moves.
Yeah.
What if technology shifts? What if HBM4 comes out 6 months early? What if the next-gen GPUs need a totally different memory architecture and they don't need this specific type of memory? Isn't there a scenario where this inventory becomes a terrifying liability?
Absolutely.
You can't exactly return custom silicon to the store if you don't use it.
That is the bear case, and it's a completely valid fear. If demand falls off a cliff tomorrow, or if the tech pivots away from what they bought, Arista is left holding a very, very expensive bag of sand. You can see it on the balance sheet. Inventory is up to $2.25 billion right now.
$2.25 billion in inventory.
And if that inventory ages, it loses value fast. We've seen that happen to other hardware companies.
Well, why take that risk? It seems enormous.
Because they looked at the alternative, and the alternative was worse. If they didn't lock this supply in, their gross margins, which investors absolutely worship, would have collapsed. They would be paying spot prices today, and their margins would be in the 50s, not the 60s.
And the stock would be crushed.
The stock would be down 20%. They calculated that the risk of having too much inventory was actually lower than the risk of having margin-destroying inventory costs. They are effectively acting as their own internal hedge fund here, using their balance sheet to subsidize their product costs and guarantee supply for their biggest customers.
That is a flex. That is using your wallet as a weapon against your competitors.
It is. I mean, look at their peers. Look at a company like Cisco. Cisco's out there talking about margin compression, struggling with component costs. Arista is essentially saying, we bought all the memory 6 months ago. Good luck to everyone else.
So they are shielding their customers and their own P&L by hoarding inventory.
Yes, but you are right to point out the risk. It cannot be overstated. They are betting heavily that they can sell this hardware. If demand slows down, if that digestion phase actually happens next quarter, that inventory becomes a very heady anchor.
So they are all in. They are betting the farm, or at least a few silos of the farm, that this demand is real and sustainable.
And so far, every data point, including their own guidance, suggests that the demand is proving them right.
Let's shift gears to the technology itself. We talk about AI networking, but what does that actually mean in 2026? Management spent a lot of time on the call discussing back-end versus front-end networks. And I feel like people's eyes glaze over when they hear this, but it's absolutely critical to the long-term story.
This is the most important architectural distinction to understand. You're right. The back end is the GPU to GPU chatter. That's the training network. When you are training a model like GPT-5 or whatever comes next, you have tens of thousands of GPUs screaming data at each other constantly. They're synchronizing gradients, sharing parameters. It has to be lossless and incredibly fast.
That's where the money is right now. That's the AI networking revenue. That's the pure juice.
Correct. That is the $3.25 billion target for 2026. That's the back end. But the front end is the user to AI connection. That's the traditional network that connects the servers to the internet, to the storage, to the users. Historically, that's been the boring part.
The plumbing.
But management introduced a new concept that I think is brilliant. Agentic AI.
Agentic AI. This is the buzzword of the year. But explain what it does to a network. Why does Arista care?
Okay, think about it this way. Today, if you ask a chatbot, what is the weather in Tokyo? It sends one request to one server, and it gets one answer back. It's simple.
One packet in, one packet out, more or less.
Right. But an AI agent, agentic AI, is designed to do work for you. So you don't ask it a question, you give it a task. Plan me a 10-day trip to Tokyo. That agent doesn't just look up one thing.
No, it has to do a bunch of stuff.
It checks flights on 3 different airlines. It checks hotels on 5 different websites. It checks your calendar for your availability. It checks the weather for that time of year. It looks up restaurant reservations. It might make 50 distinct queries to dozens of different databases and servers just to answer your one prompt.
So one single user request turns into 50 network requests inside the data center.
Exactly. It creates a massive multiplier effect on traffic. It's what we call east-west traffic server-to-server communication. Management's argument is that agentic AI is going to drive a huge new wave of demand for classic enterprise switching.
So the front end becomes just as important as the back end.
Potentially, yeah. If AI agents start doing our work, the front-end network needs a massive upgrade to handle that traffic explosion. It's not just about the training cluster anymore. It's about the inference traffic flooding the rest of the data center.
That is the pivot. It's how they keep growing even after the big training clusters are built. They sell you the back end to build the brain, and then they sell you the front end so the brain can talk to the world and do its job.
It's a fantastic long-term vision. And regarding the back end, we need to touch on the speed. 800 gig is the standard now. It's not the future, it's the present.
800 gig Ethernet.
Yes. They mentioned on the call they have over 100 cumulative customers for EtherLink, which is their 800G product line. That adoption curve is vertical. But the real expert insight here is what comes next. They are already talking about 1.6 terabit.
1.6 terabit. My home Wi-Fi is struggling to do 100 megabits in the corner bedroom, and they are talking about 1.6 terabits per second per port.
It's just a mind-boggling amount of speed. 1.6 terabit is the next battleground for late 2026 and 2027. Arista is co-designing rack systems for this, and this connects right back to the Ethernet versus InfiniBand war. The Ultra Ethernet Consortium, or UEC 1.0 spec, is being finalized.
And that's the industry standard crew.
That's the industry coming together to say, we don't need proprietary cables. We can make standard Ethernet fast enough and reliable enough for the biggest supercomputers on Earth.
And Arista is leading that charge.
They are a founding member. And based on that fourth customer win, it's working.
One other tech piece they mentioned that I thought was interesting was the blue box and NetDL. It sounds like a spy gadget. The blue box.
It does. NetDL stands for Network Data Lake. And the problem they are solving here is visibility. As these clusters get bigger, we're talking 100,000 GPUs. Debugging them is an absolute nightmare.
I can't even imagine. It's like trying to find a loose cable in a stadium full of servers.
Exactly. If one cable is loose or one switch is misconfigured, the whole multi-million-dollar training run can slow down or fail. And when you are burning millions of dollars in electricity per day on a single training run, you cannot afford a slowdown.
It's literally money burning while you try to find the problem.
Right. So Arista is selling visibility as a premium feature. The blue box is essentially an analytics engine that hoovers up all the telemetry from the network and tells you exactly where the bottleneck is. It tells you, hey, switch 405 in row Z is dropping packets. It's high-margin software on top of the hardware.
It's peace of mind for the person running the billion-dollar cluster. It's insurance.
Exactly. And it makes the hardware stickier. Once you start to rely on that dashboard, you really don't want to switch vendors.
Okay, let's zoom out to the investor context. We have the numbers, we have the tech, we have the customer story. What does this all mean for the stock and the sector? What is the bull case here, boiled down?
The bull case is actually very clean. You have a company at a $9 billion revenue run rate that is accelerating to 25% growth. That is incredibly rare. The digestion fear was proven wrong. The hyperscalers are accelerating, not stopping.
Right.
And on top of that, you have incredible EPS leverage kicking in. They raised their operating margin outlook to approximately 46%.
46% operating margin. So they are growing revenue at 25%, but earnings might grow even faster because they are so insanely efficient. They are getting more juice out of every squeeze.
Yes, they are just printing cash at this point.
Okay, play devil's advocate one more time. Give me the bear case. Why should I be worried? I know we talked about inventory risk, but what else?
The bear case starts and ends with concentration. We talked about customer B being 26% of revenue. If Meta decides to cut CapEx, or if Microsoft shifts its AI strategy, Arista takes a massive, massive hit. You cannot diversify away that risk quickly. You are effectively tracking the CapEx budgets of two companies.
And the supply chain fragility?
That's the second risk. They are short memory in a rising cost environment. Yes, they have their purchase commitments, but those aren't infinite. If memory prices double again, that 62% gross margin floor might finally break. They can only absorb so much pain. If HBM goes parabolic again, Arista gets squeezed.
And valuation. The stock pops 7% plus. It's not cheap.
No, it's priced for perfection. When you are trading at these multiples, any slip up a missed quarter, a slightly lowered guide gets punished severely. There is absolutely no room for error here. You have to beat and raise every single time.
But the big takeaway feels pretty definitive.
I think so. So what is that this earnings call confirms that the AI infrastructure build-out is a multi-year supercycle. It is not a one-year wonder. We are in year 3 or maybe 4 of what might be a 10-year build. The game is still in the early innings.
And even though the enterprise segment is lagging, I mean, it's growing way slower than cloud, They still kept that campus revenue goal of $1.25 billion intact for the future.
They did. They aren't giving up on the boring office building networks, even if the AI cloud is the star of the show right now.
All right. We have covered the beat, the raise, the memory squeeze, and the slow death of InfiniBand. Now it is time for the segment that keeps our legal team up at night.
My favorite part of the show.
This is not financial advice. We are not financial advisors. We are two voices on a podcast. Do not sue us. Do your own research. But if we were pitching a trade to an investment committee based on this earnings call, a wild asymmetric bet, what would it be?
Okay, I've been thinking about this. I'm calling this one the memory squeeze straddle.
I love the name already. Break it down for me.
Here is the setup. Arista has hoarded memory chips. They have $6.8 billion in commitments. They have the supply lock-in at prices that look pretty good today. Their competitors, the generic server makers, the white box switch vendors, even some of the legacy networking giants are buying on the spot market. And the spot market is, to quote the CEO, horrendous.
So Arista has the goods at a fixed or at least a known price. Everyone else is paying a massive premium just to get in the door if they can get parts at all.
Correct. So the trade is long ANET, short generic server hardware. Think companies like Supermicro or the Dell server business, anyone who is heavily exposed to spot pricing for their lower margin boxes.
I like that. It's a classic pair trade. You are betting on Arista's supply chain dominance, not just the direction of the market.
Exactly. Arista wins on availability because they actually have the chips to ship, and they win on margin preservation. The competitors have a terrible choice. They either have to destroy their margins to ship the product, or they have to delay shipments because they can't get the parts at a price that makes any sense. It's a win-win for Arista and a lose-lose for the others.
That is a vicious trade. I love it. Do you have a wild angle, something even riskier for the options crowd?
The wild angle, the real Hail Mary, is long ANET called short InfiniBand providers.
The death of InfiniBand trade.
That's the one. You are betting that the fourth customer flipping to Ethernet causes a cascade. If the proprietary interconnect market collapses faster than Wall Street expects because everyone follows the fourth customer's lead, the pure play InfiniBand stocks and the divisions within companies that rely on that are going to get absolutely crushed while Arista absorbs that market share.
High risk, but if those dominoes fall, they fall hard and fast.
Exactly. It's a bet on an accelerating trend.
Well, there you have it. Arista Networks. They beat, they raised, and they are hoarding memory chips like squirrels before a very, very expensive winter.
A very profitable winter for them, it seems.
Keep your eyes on the ticker. We will see you next time.
Take care.